There has been an awful lot of drawdown in some of retail traders' favorite stocks, especially when it comes to options trading. And today, what I want to cover is what to trade inside of your account in order to stay as safe as you possibly can in the market and protect your account from these drawdowns in the future. Now, first things first, this is not financial advice. This is simply what I'm doing and or have done based on my individual goals and risk profile. Don't blindly copy strangers on the internet. Do your own research, make your own decisions, and get good at managing your own money. So, firstly, when it comes to trading, I think especially with options, most people tend to overtrade. You're better off getting really, really comfortable with less stocks. And what I mean by comfortable with less stocks is understand them inside and out. What does the business do? What does the chart do? What moves the stock? Is it cyclical in terms of maybe the economy? Is it cyclical in terms of yearly, momentum? Get really good with few stocks because this is what allows you to be confident when you see a good setup. How many times have you seen a setup and you're like, should I, shouldn't I, should I, shouldn't I? If you just look at few stocks, when you see that, you'll stop second guessing yourself. And the next reason is it also keeps you out of doom scrolling every day. How many times have you just looked through the watch list over and over and over and over again, trying to see something but not seeing anything, even though there's some really good setups there? So that's number one. Stop over trading. How I like to do that is by following 20 to 30 different stocks or ETFs from various sectors at the most. So if you're sitting there now with a watch list that's just full of stocks that you've never traded, get rid of them. And then really get to know the charts and the businesses of the stocks you keep. Now, I also don't want to be trading these 20 to 30 all the time either, because as you'll see in just a moment, they come in and out of the period of time that's ripe to trade. So by having sort of 20 to 30, maybe even less, you'll have ones that we're actively trading now and ones that are in our coming up next kind of basket. And this will ensure that you're confident in your trades. And it also helps prevent you from being stuck with crap that you don't want. And I say that because I have been guilty of it, right? Like I still have things in my portfolio where I'm like, why did you trade that? You heard someone talk about it or you jumped on a bandwagon. You shouldn't have ever had that in your account. So oftentimes it doesn't matter how long you've been trading for, you still can get stuck in this cycle. And it's something that I am this year being so particular on, is not trading things because someone else said it's a good trade. The other thing, of that 20 to 30, only trade profitable companies. Now, ETFs, separate story, of course, because that's made up of baskets of different companies. But if you're looking at individual businesses, got to be profitable. And by profitable, I mean at least a 2-year history of both rising profits and also rising guidance. If we're, meeting targets, if we're rising profits but revenues may be coming down or guidance is starting to come down, that's probably a red flag. So profitable, at least 2 years of rising profits and rising guidance. And less is more. Hear me out on this one. And this is going to be a personal decision, right? Depending on the size of your account, if you've got a limited account, the typical advice is don't put any more than, say, 5 to 10% of your account into one ticker. That's great in theory. It's great if you've got $500,000 to $1 million. But if you've got, say, 50,000 and you're only looking to put 10% at the most into each position, you can then only trade crappy companies, right? We can then only trade stocks that are at the most trading for $50. Would you have preferred to have had an account at 50,000 that's spread out over 10 $5,000 positions? Or would you have preferred just to have traded, call it Nvidia and Walmart? So choose two very strong companies that aren't going to go to zero, trading covered calls and sold puts, and then maybe put the balance in something, again, really safe, SPY spreads. I say safe, quote unquote, right? Everything has risk to it. We know that. There's always a potential for loss, but there's less potential for loss if our account is made up with, well, number one, the SPY, but number two of the most stable companies on the stock market. And I think the last 2 to 3 months have proven it with Nvidia. Tech stocks are down by 30, 40, some of them 50+%. Nvidia is down by next to nothing in comparison. And Walmart reached all-time highs just last week. So think about that and really just consider what you've got in your account, and if you could start it from scratch again, what would you do? What would you get rid of? What would you keep? Now, how do we figure out what we're going to trade? We want to create 2 different watch lists in our account, in our trading view. One for our bullish stocks. What's a bullish stock? An upward trending chart like this. Importantly, the 20 moving average, which is the middle of the Bollinger Band, or if you don't use Bollinger Bands, you can literally just put in a 20, EMA, a 50 EMA, and a 150. They must be in this order, low to high, in order for me to class this as a bullish chart. So GE, aerospace, yes, tick. We've got the 150, we've got the 50, we've got the 20, and the chart has been rising. I say rising chart for a minimum of the last 18 months, and this ticks the boxes. The next watch list I call awaiting recovery, and that's for stocks that no longer look like a bullish chart, as in our last lot of trading data is trending downwards. So if we come back to GE, so yes, we had all of our moving averages in order, but we're still making higher highs as well, right? Higher high, higher high. We're also still making higher lows. So bullish chart, the moving averages, higher highs, higher lows. Awaiting recovery, for me, something will go in awaiting recovery when we make the lower high. And when our 20 when our 20 moving average is lower than our 50. Now, they don't go there to retire forever, but all of my new trades, and this is something that moving forward, I'm going to get much more strict on as well. All new trades, for me anyway, for the foreseeable future, my new rule is that they will all be from bullish charts. That's it. Rising 18-month chart, 20, 50, 150 moving averages all intact, and higher highs, higher lows. If the 20 moving average is below the 50, that's a don't trade sign. Okay. The other time that we can look at a new trade on a awaiting recovery chart is once we have the confirmed direction change. What's a confirmed direction change? We get higher highs and higher lows established. So we will at least have a double cycle of that. We get our bottom, we get a higher high, we get a higher low. We get a higher high, we get a higher low. To me, that's then able to come back in my Eurocator trade section, right? So what does that mean right now? It means charts like Palantir are out. It means Robinhood's out. It means most tech is out. So instead, I'm looking at what's currently on my bullish watch list. And I think something that can keep me in that we only trade the bullish stocks is by following these general rules. Don't go heavy into growth stock and don't premium chase, right? Because I think these two come hand in hand. Yes, we get the higher premiums in these growth stocks, but higher premiums, this is why I like covered calls so much as well. Higher premiums don't always mean higher returns. Because if we get a high return on a sold put, for example, but then we get put the shares and then we're underwater and then all we're trying to do is crawl our way out of that trade, even though on, for example, a stock like Walmart, we would have received a less percentage for our, if we were doing a covered call, we'd receive a less percentage for our premium because we own the shares. All we need is to have a strike price $2, maybe $3 above what our acquisition cost is. And if we get the call away, then we're at equal profit anyway, right? So we don't have to premium chase when we're following the bullish charts, because what's going to give us that gap between the return on a high premium versus the low premium stock, what's going to close that gap is the capital gains. And I would much rather the capital gains over the premium, because the capital gains means the trade went well, right? I thought the trade was going to go up. The trade went up. I got my shares called away. That's a win. But in premium chasing, if the stock goes against you, then yes, you've got the premium, but the trade went wrong. So for me, that's a big focus this year, is following the bullish charts, not the premium, and quality over quantity. Admittedly, I also got caught with too many positions over the last 12 months. And I found myself at the end of last year in sort of September, October, I was kind of going, I got too much in my account. And thankfully, I could see that, you know what, I think the end of this year is not going to end so favorably. So I wound out a lot of positions in profit at the end of last year to really just refine and come back to that quality over quantity. And the next part, research. You will find that you are so much more grounded and centered and confident in a pullback when you know what the business is. When you've got stocks in your portfolio that you don't really know what they do, you don't know what drives the business, you don't know what influences it, you don't know, will they be here tomorrow? And you've got that doubt. The doubts go when you know the business inside and out, right? Amazon, for example. Amazon's down right now. I understand Amazon inside and out. Number one, as a consumer. Number two, I've actually had Amazon businesses before. So I understand the platform, right? I understand also their data stuff. I've researched it. I know what will and won't move the needle on their profitability. So when Amazon has a pullback, I don't freak out. So I hope that is helpful. I think I want to say as well, if you find that right now you're in a position where you're doing a lot of cleanup in your account, that's a good thing. There is going to be so much opportunity coming out of the market really soon. And for me, I'm doing a lot of sitting on my hands right now. I've been very selective with what I do and don't go into. Over the last couple of weeks, I've done very minimal trading. I've done primarily SPY spreads, and I've also had a few positions on energy stocks. But other than that, I've kind of been sitting on my hands just waiting. And sometimes that's okay as well. So if you want to learn a bit more about this, this stuff here, this like establishing the portfolio, for me, I find it's the fundamental part of trading. And it's the very first thing that we look to do inside of my mentorship, which is starting again next week. So if you're keen, if you want to work closely with me to, get a heads up on your trading, check out the link in the description. I take a maximum of 10 people at any given time. That's it. So it's not a big, massive group, one size fits all. It's very much what you need. Let's just get in. Let's build your account. Let's grow it. Let's get some good strategies in there. And let's make sure that this next 12 months is the most profitable 12 months that you've had, even if the stock market goes down. Because ultimately, we can still make a bunch of money when we have a direction. That's been the problem right now, I think, is that for the most part, we just haven't had a direction. It's been this sort of chop fest. It's been very specific on, exact stocks. But as far as the market as a whole, we've just been chopping about, which makes it trickier than having a confirmed direction. So anyway, links in the description. I hope this was helpful. If you have questions, by all means, feel free to reach out about the mentorship. There's an email address in the link that you'll find in the description. And yeah, I'd be happy to have a bit of a chat with you and see if this is the right move for you.